If you can afford to hold on to the property until you see fit to dispose it, you can use tax loss harvesting when it's beneficial. We touched on this strategy briefly earlier on, but now let's go into it in a little more details. What is tax loss harvesting? Tax loss harvesting is a smart approach that involves using your investment losses to your advantage. Think of it as the financial equivalent of turning lemon into lemonade, or in our case, turning your losses into a potential tax benefit. How does it work? Let's break it down a bit further. When you sell an investment at a loss, you create what is known as a capital loss. It's like a getting out of tax jail card in the game of investments. This card can be used to offset the taxes you would owe on the profit you had made from other investments. So you are basically telling the taxman, hey, I had a rough time with some of my investments. Can you go easy on the taxes, please? Why is valuable? Now you might be wondering why this is such a big deal. Well, the value is in keeping more of your investment gains instead of forking over a big chunk of your profits to the tax collector. You are optimizing your strategy to minimize that bill. Over time, these savings can really add up, and you can use the extra money for something more exciting than paying taxes. You can do this by year-end by looking at what you can sell at a loss to offset the tax liability for that year. You can also stock up on losses and carry them forward indefinitely for future use. Let's look at an example. Imagine you own 2 rental properties. Property A has been doing really well and it's gained $20,000 in values. Great news, right? But property B hasn't been so lucky. It lost $8,000 in value. Now, you want to make the most of your situation, especially when it comes to taxes. Step 1, you would sell the property A, which has made you $20,000. Now, usually you would have to pay tax on that whole $20,000, but we are not going to do that. We're going to do step 2, which is selling property B. So it's going to give you a loss of $8,000. So this is when the magic happens, so you can offset the gain from property A. So with this strategy, the $8,000 loss from property B reduces the $20,000 gain from property A. You only owe tax on the net gain, which is now $12,000. So that means you save some money. So using this loss is going to put some extra saving in your pocket. Hopefully this explanation shed light on the concept. Let's move on to the next video.